Chelsea, welcome to Women Investor Wednesday. How are you?
I'm great. Thanks for having me.
So, 5 years ago, I read a stat that says that of all of the commercial real estate investors in the US, only 3% were women. And of that 3%, half were spouses signing on guarantees and women who inherited family properties. And that meant that I was part of like 1.5%. And I thought that was crazy. So I started interviewing women saying, do you invest? Why don't you invest? I mean, these are women that do real estate on a daily basis. Like they rep Starbucks, they find a site for Starbucks, and then they hand those two pieces of controlled opportunity to a guy to develop it. And at first, women were saying, it's too complicated. And like, well, do you invest anywhere? Oh, yes, the stock market. Okay, that's not complicated. And then it's too risky. And the same thing. Well, my Netflix stock dropped 80% last year. And I kept drilling down. And then finally, something that made sense to me is they said, we don't know any other women doing it. Now that makes sense since there's only 3% of us. And I said, that's something I can help with. And I did this is during COVID. I did a virtual summit where I had 100 women on this virtual webinar. And I interviewed 8 women like you and me who are investing. And I said, I'm going to try to get as many women on platforms of women that are investing so that the women who are thinking about it can't say that they don't know any women. So we've had a conference. This will be our 5th year. And then the conference turned into this podcast because we only have 200 to 250 women that come to the conference. And, there's a million women out there. So I figured let's get the podcast going. So I think I've interviewed 30 women on the podcast. And so this is why you're here. That's what Women Investor Wednesday is all about.
Yes, I love it. Thank you for sharing some backstory. I couldn't agree more that as a woman in the space, we always feel like the minority, particularly in commercial real estate. So it's wonderful that you have this platform for women to come learn, grow their network, grow their finances. I'm incredibly passionate about that as well.
Exactly. So tell the audience a little bit about you. And then we'll get into investing and sharing our journeys and your story.
Absolutely. So Chelsea Garber, born and raised in New York, just outside of the city. I spent my adult life and career in Manhattan because that's what I was told to do. Go to school, get a good job, work really hard. My father was a businessman who owned companies in New York, and my mom was a stay-at-home mom. My parents had gotten divorced, and what I saw was that my mom really struggled when the family separated. And I continued on with my journey and actually went to school for interior design, so got a degree in interior design. Went to work for award-winning design firms in Greenwich, Connecticut, Manhattan. Eventually started my own design firm doing super high-end residential, like working with the 1% of the 1%. And while it was incredible, I loved the experience and getting to what I felt was kind of at the peak of my career. I found myself incredibly unhappy, unfulfilled, and just unwell. I thought to myself, there has to be a different way to create wealth that is not just, I thought I would make, when I'm making multiple 6 figures and I have X amount of dollars in my bank account, all my problems were going to go away. And on the contrary, it was the opposite. I just kept digging myself into a hole that I felt like I couldn't get out of. So being in the space very heavily in construction, design, architecture, I loved getting to work with teams and putting together creative ideas and coming to an end result that people loved where they lived or where they worked. And I thought, okay, what can I do next? I need to do something different. And real estate was kind of in the back of my mind, but I wasn't really sure. This is 2017. Wasn't quite sure how to segue into real estate. I didn't have any background in finance. I certainly had no experience in real estate. So I started listening to podcasts. At the time, Bigger Pockets was, the thing. There really wasn't all these gurus on the internet yet, at least in the syndication space. So I made my first mistake, which was I started flipping houses. I was buying houses out of state in Birmingham, Alabama, because you could buy houses for cash and remodel them. And I thought, great, I'm going to build a rental portfolio. I'll get, 10, 15, 20 rentals. They're going to cash flow. I'm going to build wealth. Well, that plan went sideways. I realized very quickly as I went to pull my cash out to refinance into debt, I couldn't get approved. I was a small business owner. So I I literally go, I could have hundreds of thousands of dollars. And they said, nope, sorry. So it ended up being a blessing in disguise. So I ended up selling the houses that I ended up flipping them instead of holding them. And I had heard about multifamily syndications. I
Okay,
knew that I wanted,
okay,
time
okay.
out.
All right. Well, okay, great. So the first thing you said was, and then I made a mistake. I started flipping houses. So was the mistake, and we're going to get to the multifamily, I promise, but was the mistake because then you couldn't refinance them, and could you not refinance them because was it because you were a woman? Because let's kind of unpack that.
Dissect that. Yeah. So because I was buying the houses with cash, I thought, okay, I will put debt on them, but I couldn't get debt. And it
Why
didn't
though?
matter because I was a small business owner, and just for tax purposes and write-offs, like it didn't look like I made any money. And the
Wow.
banks were super, super tight about lending. So I could have, like I said, hundreds of thousands of dollars in my bank account, and I'm buying $40,000, $50,000 houses. I'm not talking like $1 million homes. So I
Right.
couldn't get loans on them. And I
How
knew
many
I
did you
wanted
end
to
up buying?
scale.
How many did you end
Uh,
up buying?
I only did 3 because I bought 3 very quickly, like right out of the gate, went in, started doing the repairs, put together the teams. You need a property manager, you need to have the broker that
Right.
you're working with, and we're going to work with an investor. And it truly was the best thing that happened to me because it was not a scalable model to the extent that I wanted to grow a real estate portfolio. Would I rather have 10 single family homes with 10 roofs, or one commercial multifamily with 1 roof and 10 residents? It's, as you know, a very different
Right. So,
model.
so, so, and you went down that path because you heard everyone talking about it on Bigger Pockets. As you know,
Mhm.
obviously, I have listened to Bigger Pockets over the years, and so you went down that path. And how great that you learned a lot of lessons
I
in
made
the
a lot of
beginning,
mistakes.
right? Right.
Yep.
But that's we do learn our lessons from mistakes more than we do wins, right?
Absolutely. Yeah, for
Did
sure.
you,
And
when you
I just
sold,
didn't
did you
have the
make money?
resources.
Yeah.
Yeah, I made some money, but it was nominal. I made money on 2 of them, and I broke even on 1 of them, but it was not it was I'm looking for calculated risk, and it felt very uncalculated. There was so much you could take into account when you're flipping houses, but if the market was going to turn, if the price of goods went up, there was unforeseen capital expenditures that came up during the process. So I did learn a ton about myself, about flipping houses. And what I realized very quickly was A, I couldn't get the financing to build a portfolio. And B, I wanted to scale. And at that point, like I said, I think I just started flipping houses because I assumed, oh, before you go into the big, large multifamily, do some single family. And the two are not correlated like at
Right.
all.
Right. Right. Okay. So perfect. Great segue. So now you sell those 3. And oh, by the way, you're in New York and you're buying in Alabama. So I can't wait to hear where you bought your first multifamily.
Yeah, well, during that phase, I actually left New York. So, like I said, I'd spent my entire life in New York. I was completely burnt out. At that point, I'd moved to California, and the light bulb went off. I could find a mentor in the multifamily space and learn the ins and outs and not make the same mistakes because I'd be learning from somebody else's mistakes. Not to say I haven't made mistakes, but
So was it a
and that's
mentor or was it a coach, and was it free or did you pay?
So it was a paid mentorship program. I actually did Michael Blanc's program. This was in 2019. So kind of at the time that many people were getting into the syndication space.
Right.
And I didn't work directly with him. I worked with a mentor, somebody who I still consider a mentor and friend, colleague, and really just got to understand, okay, how do you talk to brokers? What is underwriting? How do you evaluate properties? Putting together, I, I came to the table with knowledge and skill sets to make this business not just a vision, but to bring it to life. But it took a lot of time. I spent the first year looking at different markets, looking at deals, and ultimately not getting into anything because I quickly realized I was a solo entrepreneur and that's how I was conducting my businesses. And although I had strategic partners, contractors, architects, I this was a new space for me, and I realized I saw all of my other peers getting deals done, and I thought, well, clearly I'm doing something wrong, and it's because I didn't have partners. And so that was the first mistake I made. But to take it a step back, when I entered the mentorship program, the absolute first thing that they had you do was identify a market that you wanted to invest in. So I did quite a bit of research and ended up in Oklahoma, halfway between New York and LA. And that's where I started building my portfolio. And most people say, well, why Oklahoma? And Oklahoma City and Tulsa, to be more specific. I had been there for business. And as I was doing my market research, I kept seeing Tulsa and Oklahoma City coming up in top 50 markets, slow, steady growth, kind of checked all the boxes you look for as an investor, influx of people, Fortune 500 companies, landlord friendly. And I thought, okay, well, I've been there. I'm familiar with these cities, and I'd much rather be a bigger fish in a smaller pond so I can develop really strong relationships and a foundation to then, start investing. And that's what I did. So I spent the first year going consistently every couple of months to the market, shaking hands with brokers, saying, hey, this is what I'm here to do. This is my plan. Got very specific on the types of assets I was looking to buy. And it really just snowballed. I got introduced to property managers, contractors, other investors in the market. And it ended up just being a very fertile ground to build my business. And I love the people there. I love doing work there. And so, yeah, that's how I ended up there.
So how long, I love, this is amazing. How long did you, from identifying Oklahoma as your market to doing your first deal, and how many deals did you look at before you put your first deal, let's just say, under contract? We don't even have to talk about yet if it closed.
Yeah, I must have underwritten probably at least 30 deals in that first year. I maybe submitted LOIs on between 5 and 10 of them. And I ended up doing my first deal in 2021. So yeah, a little over a year, and that was through an off-market deal through my network. And at that point, I had partnered up with some people here locally in Utah that were also interested in the same market. They had done some other deals, not in the market. So it kind of just all came together very organically in the sense of forming a partnership and getting into the first deal. But it was every day, it was one of those things I kept reminding myself, just continue to believe in what you're doing and why you're doing this. And it's not a matter of if, it's just a matter of when. And there was a lot of times where I wanted to give up because I thought this is too hard, or I can't do this, or I'm not going to find a deal. And just like anything in life, I always believe it's a lot of the same boring, monotonous things on a daily basis that you do over and over again that lead to success. And there's not really, it's not rocket science what we're doing. It's consistency is key, and relationships are key.
Absolutely. So you mentioned Utah. So you did move from LA to Utah.
Yep, 2020, September of 2020, I moved to Utah. I had at that time been in the space for a little over a year through my mentorship program. So I got connected with some really wonderful people at these national conferences, and I ended up in Utah because I love Utah. I love skiing. I love horseback riding, all kinds of fun things here. Just different quality of life. And I ended up partnering up with some folks here in Utah, like I mentioned, one who was a general partners, two of them, and then a third general partner, but also a key principal. So the KP is really the the cherry on top. Especially when you're getting into the space and you have no experience and you need to leverage somebody else's balance sheet and experience and network and net worth. So it was again all about putting together a really strategic team. So we formed a team and we started doing deals together. All out
So
of
let's
state.
talk about the first deal. How did you
First deal.
find it? How much was it? All the good stuff, all the details.
So the first deal was 51 units in
Wow.
Oklahoma City, C class, very distressed, incredibly. Where do I even start? It was. I think we bit off a little bit more than we could chew. we, you go to these properties and you're going on property tours, and one of the things that I will say, go see properties at night. You'll really find out what type of residents are living there and what is going on. So we got the deal off market through a broker. The deal was definitely in distress, both from a capex standpoint, resident standpoint. So this was a heavy value add. So we came in right out of the gate knowing that we were going to need to remodel all of the units. All units were classic. There was quite a bit of deferred maintenance. We were going to have to place roofs, like big projects, and it was going to be a project. It's sort of a transitional neighborhood, not the best neighborhood, definitely not the worst, but we didn't really quite know what we were up against until we got in there and realized we have to clean. There's a lot to clean up. There was just a lot of residents who were, not paying rent. There was crime. There was all kinds of things going on there. So for the first year, we spent endless amounts of time and our money into getting the community into a safe place for people to live. And when we started remodeling units, the demographics sort of started to change. We were able to raise rents. We put up security gates. It really, a place that once had full-time security, now has nobody, but it was a labor of love.
How much? What was the price point that you went under contract for? And then did you reduce that during due diligence?
Yeah, so we bought the property for, let me pull up a calculator. I think it was 2.3 million, 51 units. Yeah, so about 45,000 a door. It might have been a little bit less than that. Plus what we had budgeted for CapEx. I think we had $450,000 aside just for CapEx. The roofs we were able to replace through an insurance claim actually from the previous owner. So we got $300,000 roofs for like $90,000. That was a home run.
Great.
Yeah. But
Did you
yeah,
spend more than the 450?
we did. Over the years, we probably put in an additional 100K or so.
That's not bad.
Um, yeah, it was more than what we had budgeted for, but that was one of the first lessons I learned is that if you can never go wrong if you have too much money sitting in your bank account when it comes to fixing problems in the multifamily space. So the more you have in reserves, the better. So that was rule number one, because we could have used the extra money. Yeah.
Right. So four of you were there four partners that went into this deal?
This deal was actually three partners, and then we have a handful of investors. So this was a syndication. We raised about, I think, $1 million on this deal through our network of investors.
And
And
did you guys put money in, the three partners?
we did. Yeah, we put in about 10%, and then over the last couple of years, we've probably put in, like I said, close to 100,000 of our own capital. To finish up some of these projects that we were
And was it
unforeseen.
did you get a loan on it too?
We did. Yeah, we got a fixed rate bank loan. The loan is expiring in 2 months, so we're in the midst of refinancing right now.
Well, this one, I'm sure this refi will go better than your flipping houses one.
Definitely. Yeah, we've got a great agency loan locked in, so long-term debt, which
That's
is
great.
which is the key. Yeah.
And yeah, so so you still own it. And was it easy? How did you find, were you the person that were finding the investors? Was it a team effort? Was there, like, of the three partners,
Mhm.
were the three of you equal partners?
We were, yeah, we're all equal partners and we had different roles and responsibilities. So I have been a deal finder. So I really enjoy the relationship side of the business, getting to, uh, you know, consistently be in touch with brokers and other folks that have opportunities both on and off market. So I found this particular deal. One of the partners is really handling the finance, kind of back office end of things. The other is, helping with operations. So while we wore many hats, there's like anything else in life, you have your strengths and your weaknesses, and how do you play upon those? So we all raised capital. That's one thing I've learned is, now that I've done 4 or 5 deals, regardless of what your role or responsibility is, everybody's a capital raiser. Getting money to the deals is what makes the deals, happen. So that's really important. And yeah, it's been an interesting learning lesson about relationships, partnerships. Who shows up and pulls their weight and who isn't. And you think somebody, and then you get to go do a deal with them, and you kind of say, okay, this person's not who I thought they were going to be. So while I'd love to say that some of the partners are amazing, there's others that haven't been, and that's been a struggle because we've had to take on more weight and more responsibility when other people are lagging. And you one piece of advice I could say is, maybe invest passively with an owner and operator before you partner with them. See how do they communicate, how do they operate. I think we were all in the syndication space very quick to get into bed with one another, and then it turns out there's not everybody has good intentions. And I've always firmly believed when you put your investors first and when you put your residents first, you do good by those, good things will come back. And listen, things
Absolutely.
happen. You communicate. You've just got to be able to communicate, and investors respect that when there's an open line of communication, like, hey, we can't pay, our pref this quarter. This is why we're choosing to take that money and put it back into the property to continue remodeling units. We're going to catch
Right,
up on the back end. A lot of it is education, and
right.
that's that's the name of the game is communication.
How, so what you had a pref and promote model on that first deal?
Yep. So we had a pref. I think our pref is a 7 pref. So throughout the life of the deal, paying a 7% preferred return, and then an equity split upon the sale. Typical structure of most of our deals are generally like a 70-30, 70% ownership by the LP, 30% by the general partnership. In other deals, we've brought in, institutional partners with pref equity, which is another layer.
Right.
I won't necessarily get into at this moment, but as
Well,
the deals got bigger, yeah.
look how much you've learned from the flipping houses, right?
Yeah, this is night and day. And there's
How,
nothing wrong with flipping houses. I should
no,
say it wasn't for my business model, which was
you
I
wanted to
don't want to
scale.
keep flipping. Yeah, I want scalability and start building generational wealth.
How many units do you own now?
Oh, about 440 or
That's,
so.
and that's in how many projects?
So the first one was the 51 units in Oklahoma City. Right after that, about 3 months later, we closed on 192 units in OKC, amongst 2 properties, a portfolio, 61 units and 131 units. Then we did a deal in Columbus, an A class that we brought from a developer, 43 units. Partners had deals there, so I ventured there, but really not my market. And then for the first time, I did a co-GP situation. So all of these deals prior, the 4 deals prior, my partners and I were the lead sponsors, owners, operators. And this past year, I actually brought my investors, all women, I must add, to a opportunity in Kansas City with an incredible group of people that I've worked with, both in my design firm. I also own a commercial multifamily design firm. Um, so it's been incredible to get to work with other groups and see how they operate at a really high level. And what was, I think, the most exciting about that was I'm super passionate about um, just expanding knowledge and awareness of not just multifamily opportunities, but how to build wealth. And as I was living in Park City, I kept meeting the most incredible women, incredibly bright, I must add, and well to do. However, I never felt like anybody was talking about money and investing and, can I create?
Women
So I
don't
create,
talk
yeah,
about money.
yeah, it's crazy to me. And I started a group called Connect Her, and it's a local group here in Park City, and it is for helping other busy, successful women, create financial freedom. And what does that look like to you? Because I think we're all in this for different reasons. And for me personally, it's time, the time freedom when you create multiple streams of income, whether it's multifamily, 401ks, life insurance policies, stocks, bond, you are one step closer to, leaving your full-time job if you prefer to, and or taking care of a family member in need or giving back to a cause that's really important to you, that doesn't revolve around our day-to-day job. And while I do love my day-to-day job, I also don't want to be beholden to it. I like time freedom and flexibility. So within the Connector organization that I've started, just really passionate about sharing knowledge about how to grow our finances. And Beth, I knew nothing about this until I got into the multifamily space and I started getting around other people who were saying, hey, you can invest with a 401k or IRA, or hey, are you working with so and so? And it just became, through other mentors and paid coaches, it became really eye-opening to me that we're not talking about this, particularly women who now have more wealth, are making more money than men, yet are, as you mentioned, less than 3% are in ownership, and so many are just not diversifying their portfolios, or just they don't have portfolios, which was so mind-blowing to me. So kind of going back to this last deal that I did in Kansas City, is I think it was 140 units. Uh, Bringing all women to this was really probably one of the highlights of my career thus far, because I'm saying, hey, like, we can do this together. Like, building wealth really is a team sport. And I was never that, like, I would say, cheerleader for women. And then I kind of became that. And so my mission has grown. And what started off as wanting to create wealth for myself and my family, turned into something much bigger, which was helping the people in our communities live better lives. And that all trickles down to the end, to the investor, and helping the women I know very specifically, um, you know help them leave an impact on the world. And what does that mean to them, and how do we
Oh,
do that through you know
bravo.
expanding our wealth? Yeah.
Bravo, bravo. How many women are in the Kansas City deal? And how much was the price tag on that? And what's the pref and promote on that?
Yeah, that deal was, I think it was about a 12 million purchase price. We raised a little over 5 million in equity. I brought 6 or 7 women investors to the group, about $500,000. Many of these women, this was their first time investing in multifamily, so super exciting. Some of which used 401ks and IRAs. So, how to leverage retirement funds is a big part of the education. And yeah, this is a 3-year hold. It's going to be kind of a shorter deal. Multiple exit strategies. If we can increase the value, the NOI within these 3 years, which we will likely will do, and the market is primed to sell, we'll sell. If not, we'll refi. So kind of just continuing to educate. This is your standard 16 to 18%, IRR, 6%. I think it's a 6% preferred return, might be 7. I don't keep track. Sometimes I lose
Yeah,
track with all the deals,
me
but
too, me too,
give
me
or
too, me
take,
too.
it's,
Yeah.
we kind of it's similar model. But this is a really great deal, cash flowing on day one. So I look for appreciation and cash flow. Like, I'm not doing deals if they're not cash flowing. I think to be banking on appreciation is super risky. Low leverage debt, fixed debt,
And are
the
you
things that
the
I've just
only
learned over the
GP in
years.
this deal?
No, I'm just a co-GP. So there's about five five of us in this deal. So I just brought a small portion of the equity, and it's the first time I'm kind of taking a back seat in an opportunity. So while I get to be involved, operationally, and I know what's going on, I'm not. They have in-house management, which is great. I'm not on necessarily every weekly meeting, but I do get on and I get to know how things are going, so I can report back to my investors. And of course, there's SEC requirements as
Right.
far as being a GP and your involvement. So you've really got to cross your T's and dot your I's. You can't just say, "Hey, I'm showing up and I'm not doing anything." But it's really been a wonderful experience, and we're going to be making our first distribution, I think, in October, November. So about 5 or 6 months into the deal, and we'll do monthly distributions, which is great. And yeah, I'm excited for everybody involved, and so far it's been going awesome, and I love the people that I'm working with. And you know that's what makes it fun, just working with
So
good people.
do you think you'll ever just do some like GP by yourself on some assets?
What do you mean?
So,
Like
like, will you identify, in, let's say, Oklahoma City, 100 units, and then you take it down yourself without any co-GPs and you bring in equity investors?
I like working with partners. I think when you're doing these types of deals, there's so many moving parts that it's like it takes a team. It really takes a
Right.
village to do this. I would right now what I'm looking for is actually smaller deals, like more like joint venture, maybe buying 20 or 30 units, bringing in a handful of other friends, investors, and saying, "Hey, we're all putting in X amount of dollars. We all have equal ownership." It might not cash flow right away, but this is a long-term deal. This is a legacy deal, 10, 15 years.
Right.
We can take more risks when it's our money versus investor capital. So
Sure.
trying to look at things differently, because the syndication space, while it can be lucrative for all people involved, it's you're in and out of deals in a fixed period of time. And at the end of the day, if you want to really build passive income, it is building passive income streams, which are buying and holding properties.
Right.
So that's kind of where my focus has switched. Not to say that I won't continue to do larger deals, but I'm definitely, now that I have the resources and on-site managers and contractors, it's now easier to go pick up something smaller and
Right.
operationally be able to continue to run a community of that size. The bigger ones are easier to run. Like when you have 100 plus units, you have an on-site manager, you have multiple on-site maintenance people. It just, from an economic standpoint and operation standpoint, it makes more sense. So you've got to be
Absolutely.
really set up to take on smaller communities.
For sure. Are you still focused on Oklahoma City, or are you open to other markets?
I definitely am staying in Oklahoma City. I would continue to do more deals in other markets with the partners that I'm working with right now. So I'm partnered with Sharpline Equity on this group in Kansas City, and I would definitely bring my investors to another deal with them in Kansas City or one of their other markets. But generally speaking, I'm pretty market specific as an owner. And again, just comes back to, it takes so much time to put into place what my team members and I have done in our markets. And it comes down to property management. Property management will absolutely make or break your business plan, as you know. And I've had some property managers that weren't so great. And the best advice I ever got from my first mentor, was, if the ship is sinking, get off. And it is so true. You've got to take ownership and responsibility of your properties, and staying on top of managers. And it's a
Yeah.
lot of work. It really
Yeah.
is. And I have a great property management team that I work with now in Oklahoma. And it would be very difficult to find someone as good or equal to them in another market, because they are a needle in a haystack. And
Is that like a third party firm you hired, or are they in-house
yeah,
under your umbrella?
nope, we're doing, aside from the deal that I'm doing in Kansas City, as that I came in as a co-GP, all the properties that I own, we have third party property management.
Gotcha. And I want to
Yeah.
go back to Connect Her, but before I do that, as we round up here, so Sharpline Equity, how did you meet them?
So I met Chris Jackson, the owner of Sharpline, I don't know what came first, the chicken or the egg. He also owned properties in Oklahoma City, and because it's a rather small market, we got connected. He was buying a property from somebody that I had done design work. I have a commercial multifamily design firm, and anyways, we got connected, and he just was somebody I really looked up to as a honest, hardworking, if something's broke, don't wait on somebody else to fix it, like go getter. And I just really like his work ethic and how he ran his business. And we started to work together in design collaboration. So I help other owners and operators increase their NOI through strategic design. So my company is called ROI by Design. We've done 200 plus remodels nationwide in the last 4 years within all asset classes, new development, 2 million, 60 plus million, everything in between. So I take a very strategic design and aesthetic driven approach to repositioning multifamily. And that starts with not just how the property looks and feel, but how it functions, and of course the safety. So Chris had reached out to me to help with some design work on one of his properties in OKC, and then the relationship continued to flourish. And he was just somebody I would lean on, and hey, get on the phone every now and then. Hey, how are you doing? What's going on with your partnerships? Like, just somebody I felt like I could be really open and honest with. And so it was great. And then I got introduced to one of his partners, who is now one of my mentors, Marco Barbaro, part of the MIH group. It's a very exclusive mastermind, invite only. And I got to just really get in a space with people who had been doing deals. We're doing deals together, very tight knit, family oriented. Marco himself has done over 40 deals. Many of them he owns outright with no partners, and just two stand up guys in the industry that I'm really honored and proud to call partners, and people that I get to collaborate with. So, again, just really strong network, and you've got to be willing to pay to play in this space.
Well,
like, most things just don't come free. Like,
I was literally going to go there next. I was going to say, not only do women not talk about money, they don't hire and pay coaches, right?
yeah, this is
It's
my
an industry.
third or fourth. Yeah, I've spent over $100,000 on coaching in the last 3 to 4 years, like, at least.
Absolutely. That, and at one point, I think I had posted on LinkedIn how much money I had spent on coaches and going to conferences and going to masterminds, and people went,
Yeah.
"You're crazy." I'm like, "Well, I own $75 million worth of shopping centers.
It's where the magic happens. Yeah.
I mean, I'm learning something, right?" So, but
Yeah.
yes, we all, I have some women that, again, are learning. Like, I don't teach in this, I want to get to connect her,
Yeah.
but at my conference, I don't teach them how to do it. I bring women on stage. They talk about how they've built portfolios, how they've bought in different asset classes. Then those speakers go into breakout rooms and they show underwriting. And then there are coaches, female, male, all kind of programs where I say, go research, because everyone wants a different asset class. And I'm just 39 years in retail. Like, I can't help you on a multifamily and industrial hospitality. I can't. So, but I encourage them to, in the beginning, they would call me and they go, "It costs $31,000. I said, "I know, pay it." I paid those mastermind fees. So, but you're going to learn. And if you want to do this, making mistakes is very costly.
Right. Yeah. I think I can equate all of my success in the last 4 years, both personally, professionally, to the coaches, the people that I've paid top dollar to work with. And it was scary. The first time I went into the Michael Blanc coaching program, I wrote a check for $24,000, which I had never done, like in my life to that capacity. And it was, while I won't go into the pluses or the negatives of any particular program, I think that's for individuals to do their research.
Right.
It got me into the space, and it got me connected with people and partners that ultimately led to doing deals and to learning. And then I went on to hire
with people that are spending that, right? Like,
yeah,
there are people that are investing in themselves,
yeah,
that are writing those checks. It's great.
yeah. You are your greatest asset. So, like you said, if you invest in yourself, and that's financially, mentally, your health, your well-being, it's just it goes hand in hand. And I've worked with capital raising coaches. I've worked with high performance business coaches. I've gone on. People say, "Do you want to do coaching?" I'm like, coaching's not really my thing per se, but bringing people together and sharing resources is similar to what you're doing, and I get a lot of joy out of that.
So tell us about how the women so tell us about Connect Her, and do you want more women involved? Are you good? Just
So right, yeah.
listen.
So right now, Connector is women within Park City, Salt Lake City.
Got it.
I really wanted to have in-person events. So every 2, 3 months, we're doing events, and they're all related to finances, mental resilience, breaking down barriers. This all starts with limiting beliefs. As women, we have so many limiting beliefs around money and finances. And I'm just a huge component that when we can take control of our thought and our minds and overcome those obstacles, we can grow our wealth. So step number one, is that. Um, I don't have any plans to expand the group as of yet. It's a pretty tight knit group. I've found that I've been more quality versus quantity driven, and that's most of the things in my life. And I wanted to deliver world class events to women that are really serious about being there and growing their money, not just, hey, I'm going to show up every now and then. Like, we're building a tribe. We're doing deals together. We're making connections outside of the group. So having a tight knit group has been really important to us, and to keep it intimate. We're talking about a very intimate topic, which is our finances, and we're being very vulnerable, and we're sharing. The more we go around the room and talk about who we are and why we're there, we're learning that we share a lot of the same beliefs, or we have the same mindset, or we're scared, or whatever it may be. And when we can all relate to one another very intimately, we can then grow and expand together. So I've done, I think, maybe 5 events now, everything
Amazing.
from having Karen Hall, who is an expert in self-directed IRA, how to leverage uh, retirement funds.
Yeah.
I had a wealth planner who worked with family office and real estate about planning for retirement. How much money do you need to make? We can make all the money in the world, but if we're spending it, we're not investing. You are not growing your wealth.
Right.
The
Buy
last event,
purses, not
yeah,
buy purses, buy properties, not purses.
yeah, exactly. The last event actually was probably one of my favorites. It was a Wim Hof event. So breathing
Yeah.
techniques, cold exposure. How, again, mental resiliency, and how does that relate to our finances? So
Yeah.
just continuing to curate events that speak to the needs and desires of the group, and just education. So it's
Love.
been amazing. And one day I do hope to expand, maybe have other partners, other women um, like myself, who are in different states, that are say, hey, I want to, spearhead the Ohio market, and
Great.
kind of have a roadmap of how did you do this? Because ultimately I would love to help many more people on a larger scale. And, I go to many speaking engagements, but right now this feels really good to me, to being able to help the people in my community and the women that I've just call friends.
How many women are in the group?
There's about 20 at any given event. We'll get, 10 to
Awesome.
15 women, maybe 25. So it's
Awesome.
small but mighty, but we're growing. The group will be a year old in November, so it's
Wow.
new, and
Great.
it's like anything else. There's no get rich quick scheme. It's, you come, you learn, you show up, and the people who are really dedicated are the ones who keep coming, and it's awesome. It's really has
And
brought.
they'll benefit the most, right?
Exactly. So it's been a really amazing journey. And, this multifamily space has, like anything else, it's had its ups and its downs, and it certainly has not been linear. It's come with its losses and its heartache, but I've learned more about myself and what I want to do for the world and how I want to serve others. And it's been a really beautiful thing.
Well, Chelsea, if you had one piece of advice for women out there that, have, the money in the IRAs and do invest in the stock market, but haven't yet pulled the trigger on a real estate investment, what would your advice be to them?
Like anything else, I think when you have fear in your life, whether it's about your finances or your career, take action, take a step. So start getting in touch with owners and operators, start looking at opportunities. Do your research. I believe people invest in what they know, and make sure you're working with people who are educating you, or willing to take the time to walk you through all of the steps and really understand, what's at play here and what's at risk. This is, there's risk involved in what we're doing. So just, you've got to know and like the people that you're working with first and foremost. You have to understand what you're investing in, and just having conversations. Just
Yeah.
keep communicating, and just get out there, take action.
Thank you so much for being on Women Investor Wednesday. I'm so glad to have met you, and we need to definitely
Likewise.
stay in touch.
Yeah, when's your next event?
March 13th and 14th in Fort Lauderdale.
Oh, you know what? Somebody else had mentioned that to me. I am going to be in India that time of the year. However, I want to come to the next event. So
Absolutely. Count on it. Well, thank you so
yes,
much. And I
thanks,
can't
Beth.
wait to continue to follow your success.
Likewise, we'll be in touch. Take
Thank
care.
you. Bye-bye.